Good afternoon, everybody. You gonna listen to Jensen Huang or you gonna listen to me? Come on. I can't fault you if you want to listen to him. That leather jacket he's got on, pretty sharp, pretty cool. Pretty cool. Yeah, I think my leather jacket might be more cool, to be honest. The leather jacket that you see me wear in the office sometimes that I won in a game of rock, paper, scissors in somebody's basement years ago. Come on, you know that jacket's actually like a super badass jacket. All right, let's jump in. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed by me through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. Did I say that right? I feel like I say that without thinking sometimes, but it's all there so you can read it. Position disclosure here. So I've got positions in VXX and UVixie that I bought pre-market on Friday, which even as of today's close, I think I'm still in the money in by like a small amount with today's pullback. So that's why I kept them, seeing if I can fight through some of the stuff that Bill was talking about today and tomorrow, and see if that can loosen up a little bit on Wednesday. Fighting the decay there a little bit. And I got some options positions on, which I don't think that you need to pay too much attention to. Some covered calls and some VIX calls. So, popping over to the market here. Do we have any movement on NVIDIA yet? Let me get this up on one of my other charts so I can keep an eye on it in case it starts moving. So a lot of expectations on this NVIDIA call today. See if they unveil anything that gets this market moving or not. All right, let's jump in. Let's talk about this market here a little bit. So how do we close? We had a decently strong day, sort of. SPY's up 0.6%, Q's are up 0.8%, IWM not so good, and the close really wasn't very good today either. The Russell finished down 0.65%. So it was another one of those days which we tend to see on days when interest rates are moving higher, or when you get some of those more inflationary prints, like what we saw with the CPI and the PPI, where the Q's outperform, the IWM underperforms. Generally not what you want to see. What we discussed in the morning meeting today for the first time is that maybe this market is actually in a more neutral environment for the first time really since the October low. Maybe it's in a more neutral environment. I'm kind of waiting for confirmation here on this market right now on which way we're going to break, which has me being a little bit more cautious, and I had started to turn increasingly bearish last week. We had a couple big days to take notice of last week. You can probably see them in the Qs a little bit better than the SPYs. First was this last week or 2 weeks ago? It might have been 2 weeks ago now. March 8th, where we had the NVIDIA and AMD tops. And then Thursday of last week seemed like a real day to take notice of. And it's hard to actually see Thursday of last week and its importance when you look at the chart of the SPYs and the Qs. It was just a day of really, really poor breath. It seemed like everything was getting smoked Thursday of last week, except Apple, Google, one other one. I can't remember. It's escaping me which one. Probably NVIDIA. Really helped the SPYs and Qs actually hold their trend and give a downside tail. But if you look at the IWM, you can really see the damage from Thursday of last week. So we kind of had 2 days to take notice of, where the last pivot low that we had before Friday, potential pivot low was on March 11th, actually did not lead to a new high. None of the indexes were able to reclaim the high of March 8th. So that's something to take notice of. This is not it's not a break of our uptrend, but it's not continuation of the uptrend, because you've got your higher low, your higher high from March 8th, your higher low from March 11th, but you never got the higher high again. And then from that point, we pulled back a little bit, so potential little bit of a lower high there, followed by kind of an equal low, and then we had our big gap up this morning. So based on the fact that the market's given us these 2 kind of warning days, based on the fact that we didn't make the new high, but also based on the fact that we haven't actually broken the trend, I'm kind of declaring that our market here has become a little bit more neutral, and we're waiting to see which way it breaks. Does the trend just continue? It need a little bit more time to consolidate, maybe need a little more time on a weekly chart, and then we break up. You'll know the key highs are Thursday's high and the March 8th high. We get back above them. Bulls are fully in control. But now with this little bit of a lower high and equal low, could we be setting the stage maybe to actually set up for a little bit of a deeper correction, especially as we finally got through this March OPEX that can loosen the mark up a little bit and roll off some of our insulating gamma, which has been helping all those small time frame dips to get bought? Maybe, we'll see. These kind of equal lows here from Friday and from the 11th have some importance. So that's about the 508 to 508.50 area for the SPYs. And I think that the real big level is still that 503 to 505 on the downside. That's the SPYs. The Qs are actually even weaker. So the Qs, same exact deal here. We had this big day to take notice of on March 8th where you had those AMD, thanks, NVIDIA's down ticking here a little bit, where you had those AMD and NVIDIA highs. That was the first day to take notice of. And then similar to the SPYs, but actually with more weakness, you had this potential higher low, but it never gave way to a higher high. So the Qs here have gone into a bit more of a range-bound market, yet we're still barely holding on to major key support. We barely held on to it on Friday. So that's that 433.50, let's call it, up to 434, where if you lose that, it's a problem. So now you come into, and let's take a quick look at the IWM before we set the stage for today. IWM, big problem on Thursday, right? We've discussed that this weekly chart in the Russell looks so much better since it was able to really recapture and get back above that $200 resistance that it failed at over the course of the last couple years here on 4 or so major occasions. We finally had the higher low on the weekly that broke us up above 200 and having this IWM look so much better. And now this picture is not looking so good. Big day to take notice of on Thursday, where we lost 203 support. Inside day on Friday, market gapped up to 203 in the IWM this morning, which we know is an important level, but failed at it, was relatively weak all day, closed on lows, almost closed below Friday's low, and this almost looks like it's setting the stage to potentially break back down below $200, which would be a really big problem. So popping back over to the SPYs and the Qs, so what we just described, I think a lot of people got excited, or whatever the right term is. Excited if you're a bull, maybe depressed if you're a bear. If you saw how big the gap up was this morning, because we had a really big gap up. But what I was trying to say in the morning is not so fast. It is a really big gap up, but I don't necessarily think it's back to business as usual with this uptrend, because while it's a big gap up, it's not clearing any of the important levels that we're discussing right now on the upside that get this market back into bullish territory from neutral territory, meaning we got the lower high potentially here in the SPYs and the Qs, the equal lows, and yeah, big gap up this morning, but we're not gapping back above Thursday's high, which is your first spot to pay attention to where we become more bullish. So I actually thought that there was a decent chance that they could fade this gap this morning. And while this market now I think is more neutral, we're waiting to see if we can break above that resistance to be back to bullish, or we break below support, which can make us a little bit more bearish, maybe create a feedback cycle of selling, maybe create a deeper 3 to 7% pullback from highs in the market. That's kind of the area that I'm looking at as far as maybe a broader dip buying opportunity, and we understand that at a certain point we could get a deeper feedback cycle of selling, and now we're in a market environment here since we're post OPEX where this market's a little bit looser and it actually is easier here. There's a window where this market can potentially weaken out. What I was trying to say in this gap up was not so fast. I actually think that this is fadeable, right? In a neutral market environment, this type of gap up is much more fadeable than in the bullish market environment that we've been in for those several months. And again, we easily could go right back to being in full-on bull mode if we get back above Thursday's high. But my initial thought process was to fade the gap, though I was a little bit nervous that we might end up just actually going sideways and digesting all day in front of, one, this NVIDIA conference, which is ongoing now, but two, and probably more importantly, the Fed meeting on Wednesday, where we're going to get clarity potentially on the amount of cuts or lack thereof at this point that the market's going to be able to provide. So it did turn into a little bit more of a boring-ish type of session, which kind of was my fear. Though, one thing I would note that was actually interesting about today's trading session is there's been so many days where we've had weak mornings and strong afternoons, and today was a little bit of the opposite of that. I was trying to fade this gap this morning, and it was very difficult to do that for the SPYs and Qs at least. The IWM was a little bit easier, select stocks were a little bit easier, but we ripped higher on some opening momentum, pulled back almost to this 80 M8 equilibrium. We were actually very strong this first hour before we totally faded, and we didn't bounce off the 80 MA on the 15. We just kind of stayed weak and grinded down, and then we had a rather large MOC sell order today, which actually pushed this market to close on lows. So it's kind of like at the end of the day, I got a little bit of what I was expecting with a pull into this gap. Not as much with the SPYs, maybe a little bit more with the Qs, and obviously the IWM was very relatively weak. But it wasn't like a spectacular trading session from an index perspective, and it does seem like the market is waiting a little bit now for, again, NVIDIA with whatever's going on with that right now, because I'm talking and not watching it, and with the Fed meeting that is going to occur on Wednesday. So I think that's the biggest market update right now, is I really do think for the first time, probably as of like Thursday, Friday last week, we've switched our market environment a little bit here from being just straight out bullish on every time frame to maybe a little bit more neutral, where the market's a little more range bound for the moment, and we're waiting and seeing if we break up through key levels that bring us back to that bullishness, or we break down through key levels which indicate a further market environment change and could indicate a deeper sell-off. Again, 3 to 7% is kind of what I'm thinking here initially. 5 to 7%. We'll see how it actually plays out, and we'll kind of take it one step at a time. So that's pretty much it. I ended up really not being very aggressive at all with my trading. I was trying to fade the market. I was calling out some like Q shorts early on in the day with mixed success because it was difficult with how strong the market was in the first hour before that kind of rolled down. And then I remember just watching how strong this market was up in here and just saying, I just want to kind of be a little bit more hands off right now. I don't want to be buying anything. I think that this market should fade on the small time frame, but I've already actually got enough on to the short side now with the TQQQ ads that I put on to the short side, and now I've got some of this VIX exposure as well. So it ended up being, I think, a pretty quiet trading day for me personally compared to how I've been trading the last several weeks this year so far. But sometimes that's just fine if you don't feel like you've got as much opportunity to go after, which is kind of what I was feeling when this market was going into consolidation mode. So that's pretty much all I got. Not too much to talk about, except for kind of a potential little change in our market environment. I am happy to answer any questions that you guys may have. Just took a look at NVIDIA here. I had a little downtick. Looks like it's bouncing back off that downtick. Cool. So yeah, happy to answer any questions from anyone. I think the first thing I'm seeing here is from Jim. New to MOC imbalance and noticed how much edge is in large imbalances. Any rule of thumb for a criteria on what trades are worth taking based on data for indexes or individual names? Where do we get this data? Sure. So market on close orders officially hit the market on close imbalance officially hits at 10:04 Eastern, so 3:50 p.m. Somehow, and I don't even know how, but we've had this information for a long time. A lot of times we can get some like early looks at the market-wide MOC imbalance on how it's setting up at I think at 3:30, and then maybe it'd update at 3:45. But really, it officially hits at 3:50, and you can see that for any stock that you're in. Just trying to see if all that data is gone for me now that the market's closed on. It's showing there, but I have a position in it, so I can't show that name. What about, there we go. So you might have to pay for this data. It's a weird one actually, where I don't pay for it. I think I was grandfathered in because of how long I've had this data from back when it was free, and now I think that they charge for it. But I can see the MOO and MOC imbalances when they actually hit. So you can see here, and this is obviously satisfied now because the market's closed. But into the close, ExxonMobil had a 135,000 share buy imbalance is what this information is showing me, and it's particularly important if the imbalances are big. The imbalances tend to be big on options expiration days or Russell Shuffle Day or big events, S&P edition, something like that. It does move the market at all. But as far as like a trading edge, at this point in time, I think it's more information than it is trading edge. It's something to note, especially if the MOC is really big. There was a time when day traders had a big edge in trading and can make a lot of money purely based on MOCs, because the MOC, so basically like that ExxonMobil that I just pointed out. So I guess to take a half step back, as an order type that people can put in the market, particularly institutional buyers and sellers, that's where it usually comes from. You can put in a market on close buy or a market on close sell order. And the idea is that for whatever reason, your institution needs the closing print price as your price to buy or to sell. So if, let's say in our universe, there's only 2 funds, and one fund needs to buy 200,000 shares at the closing print, and one fund needs to sell 100,000 shares at the closing print, then you're going to have a net imbalance of 100,000 shares, right? So how will that get satisfied? Well, that gets satisfied through supply and demand, right? The higher the price goes, then the more potential sellers can come in. So if there is an MOC imbalance that is to the buy side, then you'll see a quick uptick potentially at 10 of 4, exactly when the MOCs hit. You'll see a really quick uptick that will be enough to kind of satisfy the demand of MOCs that's to the buy side that's outweighing on the sell side, which maybe that's even just a couple pennies on 100,000 shares on ExxonMobil. It's not necessarily a big deal, but the bigger that imbalance becomes, the more market moving it can be. I have generally found on a market-wide basis that anything above $1 billion to buy or sell as an MOC can be market moving. And back in the day traders could make a living, like literally a living, just waiting for the MOC imbalance to hit, and if it's a big buy imbalance, just pressing your market buy to beat the rest of the environment from having to kind of move up towards it. At this point in time, that's all done robotically. It's done so fast. The second that MOC hits, you can see the entire market flash up, flash down, and that's because it's a speed game now with the high-frequency trading robots that actually come in to take advantage of that. So we really don't have any trading advantage with that information anymore. It's notable, and maybe if you're a super quick trader, I do still know actually 1 or 2 people who still trade MOCs successfully by hand. It's never been a game for me, but on a really, really big imbalance, you might be able to, buy or sell the second it comes out to be able to make a quick buck for yourself. It just becomes difficult because then they refresh the imbalance data at 5 of, and sometimes you'll see a flip, and then you could get completely caught in the wrong direction on it. So the people I know who do it, even the people I know who do it robotically, all say that trade has just become a significantly more difficult trade, and that the edge that they used to have in it, they don't really have in the same way anymore. So I hope that helps, Jim. From Carol, we're slowly getting into the state when software starts to produce software, when it could be singularity pretty quick. The only thing stopping it now is the current limit in the size of transistors that limit computing power. whatever you're saying is way above my head. I am not a tech guru, tech expert at all whatsoever. Sounds to me like you're saying humanity is going to become extinct from AI, which I know that's one of the things that people are talking about, but there are plenty of ways that humanity can become extinct. So let's just see which one takes us out first. I like to think that in the short time frame I'm always a bull, but in the very, very big time frame I'm always a bear, because one way or another has to come to an end. Just hopefully it'll be after my lifetime. So back to more optimistic thoughts and questions. What else do you guys got for me? From Ryan. I'd love your feedback on my Uber swing and position management. Okay, let's take a look at Uber. That long on February 14th. Love it. How long on February 14th and my price was a bit below 76. Okay. And I held on to it a bit after that strong day. My stop since then has been 75.81. Why? Okay, it's probably, I see why. Probably because of the February 20th low. Was there a new high after the February 20th low? 81.86. What's this high? I love it. That's a great little trailing stop. The February 20th low. I was watching closely on Friday and I decided to keep my position. But it went, did it go past it? Hold on. What did we say? 75.82 and 75.81, and this low is 75.77. Closed below it. Not sure I like this. Let me see. I was watching closely on Friday. I decided to keep the position and be a bit greedy since it closed within a few cents on my stop, but it closed below it, right? The tricky one is when it closes a few cents above it on what to do. But look, I'll circle back with that thought. With a plan to focus on the price action this morning, with the gap down this morning, I was forced on giving it the 15 minutes before I got stopped out. I think that's the right thing to do. And I bought a bunch into the downside extension at 9.55. All right, but then you're still in it. That means after the first 15 minutes. That worked well, but since Uber closed further below my original stop, I closed the position. What do I think of this? I don't think that you should have capped the position over the weekend. It very clearly closed below your trailing stop loss on Friday, even if it's by 4 cents. Or actually didn't close below it, but it traded below it. Did it do it in the beginning of the day? Let me give you the benefit of the doubt on one thing. No, it did in the middle of the day. I think you should have stopped yourself out on Friday when it triggered past your spot. The tougher thing, I didn't do it in the middle of the day. Did it right in the close? Let me see this again. Oh, it's so hard. I still think you should have stopped yourself out because it broke the price, and even if it did at the very end of the day. The hard part, and I think it's worth going over. So I think very objectively, you have a stop at that price. I'd be fine with it if it broke your stop loss in the first 15 minutes and you didn't get out of it because you're giving 15 minutes, which is something that I do, and there's a reason why I do that. It's because panic selling typically happens in the first 15 minutes, and I don't like to sell into panic selling or buy into panic buying. And that 15-minute rule has actually saved me a lot of money over time. Sorry, one quick second here. So that I'd be okay with, but if this broke at any other point during the day, whether it's the middle of the day or at the close, and it broke at the close, I think you got to stop yourself out. The really hard part is, let's say your stop is 75.81. And then it closes at the low of the day at 75.83. That's like the really, really hard one for me that I don't have a good answer for, because it's technically closing above the stop loss. It didn't stop you out. But it's a swing position, and the whole point of swing positions is that you have to have enough of a profit cushion to actually be able to continue to keep the position comfortably so that you're in a win-win situation. Because if you're only closing with a 3-cent profit cushion, now it could very easily, it's Uber here, this thing could very easily gap $1 against you, and then next thing you know, you're selling $1 plus out away from your stop loss against you, and that just sucks. But I would typically, honestly, if it closed at lows at 75.84, I probably would keep the position, just because I'm a stickler just for the rules, and it never actually triggered my stop, so I'm going to keep the position, and then I'll just deal with what comes the next trading session. And if it gaps past my stop loss, I've got rules for that, and I'll follow those rules. But that's not what occurred here. It actually triggered through what your stop was supposed to be. So it actually gets rid of the difficult situation for you. Instead of keeping this thing, I see that it closed 20 cents or whatever actually above your stop loss, but that's such a small profit cushion for a $76 high beta tech stock, that, it actually takes away the difficult decision for you. I think you should just be getting stopped out because your stop was supposed to be there. And then you don't have to worry about it gapping a dollar plus against you, or trading the way that it did this morning and then salvaging yourself. So that's one. The next thing I would say about today's price action is, if it's trading below your stop after 15 minutes, I got to stop myself out. I think that you're way too close with the way that you're approaching this, between not getting out Friday into the close when it broke where your stop's supposed to be, and not getting out after 9:45 when now it's after 15 minutes and it's trading below your stop. I think that you're way too close to playing this game of, well, I think it can come back because it's my swing position and I really want it to work, or I'm just going to give it that extra bit of space or whatever, where you quickly go from trading from a position where you're in a win-win situation to trading from a position where you're in a lose-lose situation, and not really having any risk rules in place for the trade itself. So that's kind of my feedback on it. I think you should just stop yourself out on Friday, and then I think if you weren't out for whatever reason on Friday, maybe you never triggered it, that you should have been out on the 9:55 minute candle from today's trading session. Hope that helps. Happy to answer any follow-up questions on it. Cool. From Rich, now that NVDL, which I think, if I remember correctly, is the levered NVIDIA ETF. Yeah, that's the 2X. This is actually a good question. I mean, not actually a good question, because of course any question that's coming from Rich is going to be a good question, but it's an interesting question that I haven't thought about. Now that NVIDIA has splits, NVDL has split 6-for-1. I didn't realize that it did that. Would you rather trade NVDL or NVDA, NVIDIA itself? It's an interesting question. My initial thought would be, I don't want to trade these levered 2X stocks because there's probably no liquidity in them. I'm really surprised to see the amount of liquidity that this NVDL trades with. I've never really thought about trading a levered individual stock. For the most part, they seem like they've been really bad products. Again, just not good, not good volume, not good liquidity. But this thing traded 21 million shares today, so this is actually interesting. And it's interesting because, and this is why Rich is asking the question, he knows that I greatly prefer to trade like TQQQ because of its price, more than the fact that it's levered. I prefer to trade TQQQ because it's a $59 ETF versus trading QQQ, which is a $437 ETF, because I can take a lot more stock with the TQQQ and therefore have a lot more game planning optionality. So I've never actually thought about this before, Rich, when it comes to the levered ETF. I would say to you that I'm open to trading it. I'm open to trading it. The one potential problem here is trading it to the long side. I might be dealing with a degree of decay because it's a levered ETF. So it depends on, if it's just a day trade, maybe this NVDL is a little bit better. But if it's something that I might be in for a couple weeks or a month or something like that, then yeah, Carol, then maybe it's not as worth it. And then the other thing is the borrow. Is NVDL an expensive borrow? It's 2 cents. Not terrible. Not great. But definitely not terrible. But so the question is, if I'm trading this thing, NVDL versus NVIDIA, I like the fact that it's cheaper. I like the fact that it traded 21 million shares. If I'm day trading to the long side, it's just going to be a quick trade. I think there's a good chance I might go after NVDL versus NVIDIA. If it's a trade that I'm getting in because there's an expectation that I could be in it, like the NVIDIA trade I had around 500, where I was in it for, weeks, then I probably will go with NVIDIA because I don't want to deal with the decay. If it's to the short side, then I'm probably going to go with NVIDIA also because I don't want to pay for a borrow. The cool thing about TQQQ is it's pretty much always easy to borrow. Pat, please. Thanks for the question, Rich. Something to think about. From Carol, if you had to choose just one trade setup that you had to trade for the rest of your life, what would it be? Well, I'm really glad that I'm not in that situation would be the first thing that I would say, because the reason why that's so difficult is because the market environment is constantly changing. So I don't have a good answer for you. I want to trade what the best trade is based on the current market environment that I'm in. And if I choose the one that is best now, 6 months later, there's a good chance that's not going to be the best anymore. So I don't really have a good answer for you on that, to be honest. I'm very happy with the fact that I'm not locked into that sort of hypothetical. I do always love a good breakout trade, though. I think that's a good starting setup for traders. How do I feel about Tesla the last couple of days? I mean, Tesla's garbage, I think, overall still. Had a massive day today. I think Dimitri said it was his biggest update in 6 months or something like that today. It was oversold. I guess there's a little bit of positive news on it this morning where they increased one of the prices of the cars. For whatever reason, the market liked it. But this is the weakest stock that's out there. And I don't really see a reason for that to change anytime soon. The technicals haven't changed, that's for sure. The technicals on this thing are still bearish. So despite it having such a big upside day, the technicals are still bearish. I'm still short, though it's getting pretty close to my stop loss. I might get stopped out tomorrow if it's up again, which is fine. But for the moment, the chart's still bearish. I'd rather be short than long, and that can change. If it becomes more neutral, or if it becomes outright bullish, then I'll change my thought process. But for the moment, the technicals here on this thing are bearish. This is an oversold bounce into the equilibrium area for the moment, and that's all. Carol, similar to MOC imbalance, when the market opens, we have opening imbalances, and the first bar could be pretty big. Yeah, but opening imbalance is still the second the market's actually opened. Really, we're sometimes seeing really big upticks and downticks when I'm doing the morning meeting at like 5 of or so, because MOOs come out and they move, or they adjust and they move the market in a pretty big way. So we sometimes see people here in the VTF, and I usually can't even really look at it because I'm doing the morning meeting, comment on, wow, whatever stock just had a really big move, and if I'm in it, I'll see that my bids or offers or something might have just gotten lit up based on that MOO. But the second that the MOO is satisfied is the second the market opens. So I don't think that that's why the first bar tends to be big. The first bar has always been big, and that's because in the first 5 minutes of the day, there's much less liquidity in the market, and that's when most institutions are moving the market. It's when most institutions are repositioning themselves around the way the market's gapped, the new news in the market. They're doing that a lot in the first 5 minutes. So you've got big institutional orders coming in that are pushing a less liquid market that's got a wider spread that tends to create those wide-ranging bars. And the volume in the first 5 minute bar of any stock that you look at can actually be a little bit misleading sometimes, because the volume on the first bar is always super big, because the volume on the first bar includes the satisfaction of the opening print, which satisfies the MOO order. So you can't really compare the first 5 minute bar to any other 5 minute bars when you're doing volume comparisons. You need to compare the first 5 minute bar to other first 5 minute bars to see if it's significantly larger than the average opening 5 minute candlestick if you're doing any sort of relative volume comparison. So, hope that helps. Cameron, to add to Carol's question, how often do you feel that the market changes in a way that impacts strategies and edge? That's an interesting question. I don't really have like a a good, standard for that. It can happen very quickly, or it can happen over, long periods of time, to be honest. You could go into an environment that, we're getting a technical correction that lasts for a week or two, and you're in a little bit of a different market environment for that week or two, and then it's right back to normal. Or you can have a more significant change that then changes the market and environment for longer periods of time. So I don't think that there's a real, good consistent rule there. There's, secular changes to the market, cyclical changes to the market. There are impacts of market environment that can potentially change over the course of shorter periods of time, think weeks. There are impacts where market environments can change for, let's call it, more medium periods of time, where you can have a market environment that's different, like changing every 6 months to a year-ish, but that could be 2 years on some occasions. It could be 3 months on some occasions. And I think that you've got, very large changes that impact the market that could be like an every 10-year event. And sometimes that is going to be related to a more actual market change than anything. Like the first thing that comes to mind for me is when the market changed from fractions to decimals. That was a massive change. There was a lot of like day traders who were able to make bajillions of dollars when it was in fractions, and then the second it became decimals, they could never really properly adjust to the decimalized market, and eventually kind of faded away. Maybe a similar but different structural change to the market, maybe not as dramatic as going from fractions to decimals, is the options environment now and what it's doing to the market, and the zero DTEs and just the overall increase in options volume. I think has actually created a structural change to the market, which has changed the market environment. That happened, I think, starting 2 years ago now, and there's been adjustments that you've had to make to that. So, I don't have like a direct, on average every 4 months the market environment changes. I think that there's a lot of different types of changes that can occur on a lot of different types of cycles, and it's our job just to pay attention to those changes over the cycles. Does it feel like the market moves become faster with the years? No. So, like in some ways yes, but I'm gonna say broadly no. So I think that I think that news gets priced into the market like faster than it ever has. Whether you're looking at like the COVID crash and how fast that movement was, or in any of these new news environment situations that the market prices in that stuff like extremely fast. But I also think it does it more efficiently. So I think that the market doesn't over or undershoot as big as it used to in like the 1980s. Like I don't necessarily think that you're gonna have like a 1986 Black Monday event necessarily occur again in the market, unless it's like a flash crash thing, but that goes back to market structure, and that's like a broken market structure. But now we also have circuit breakers in place that are supposed to be able to prevent that to some degree. So it's also a tougher question to kind of answer, because I think it depends on how you look at it. So it's like in some ways, yes, it's faster. Like those events get priced in, that information gets priced in some ways so much faster. But in other ways, I feel like it doesn't over exaggerate the moves in the same way that it used to, in which case you could argue that it's slower, right? You very quickly are snapping back to equal like I don't know how fast COVID was on the upside also, right? Like I don't think that you would have had, and again, this goes back to saying, is it faster or slower? I don't think that you would have had as fast of a crash and as fast of a recovery in previous years with COVID, the COVID market move. But I also think that the movement would have been more if that event occurred in like the 1980s compared to 2020, if that makes sense. So appreciate the question. Hope my answer helps to some degree, and just in your thinking markets. Popping over to the YouTube. Gabriel asking me about me trading options. I turn them on every once in a while. I think the last time that I had them on was July and August of 2023, and then I turn them off again. I turn them on every once in a while if there's a particular trade that I'm interested in, or I want to learn. I probably have more theoretical knowledge on options than practical knowledge because I've traded options so little over the years. But once in a while, if I want to take a certain position, I want it to be able to have some VIX long exposure that wasn't specific to VXX and UVIXY, because those products are so terrible. So I decided to turn it on, and it's like, well, if I'm turning it on, I might as well sell some covered calls to generate some income on those positions that I can also utilize to fund my, VIX calls that I'm kind of having on a little bit. But like I said, when I showed the disclosure, I wouldn't overread my options positions. They're very tiny compared to my equity positions. I'd say overall, my one VIX call position has a little bit of size to it, but overall the positions are very small. I'm learning. From Gabriel, the croissant guy says the best way to play the VIX trade is long dated, farther expiration VIX calls. Yeah, I'm thinking about adding on some longer dated VIX calls as well. Once we get through these next couple of days, honestly, the only thing that helped that kind of made me just go after the April calls for the moment was that I'm not sure how long I want to leave on my options data, so I don't want to just buy. Potentially would be interested in buying some July calls, but I don't want to just buy some July calls and then lock myself into paying for the extra market data for the next 4 months or whatever. But maybe I will. We'll see how it plays out. From Gabriel, what do you think about DraftKings relative strength looking bullish? I guess March started, and there's like a sport thing called March Madness that I don't know very much about. And I think that helped DraftKings stay strong today, according to what people in the VTF were telling me. I think that the chart looks great. $44. I was saying it years ago, don't ever count out Americans' love of vices, which includes gambling. So you're getting to be long Americans' love for gambling, and I like that idea. The biggest downside, I think, on DraftKings is just the competition in the space, but the chart looks great. So it looks great getting back above those tails that are a little bit below 44 from earlier in this month. So I like it. On the bear side, Affirm, Upstart, and Twilio might set up tight bearish handles to press continuation shorts if the market breaks down. So quick look. Yeah, I was really upset that I missed that Affirm short on Thursday. I really wanted that. If I can get a little bit of a bounce back closer to this 80 EMA or like a retest of this 36, I'll probably be looking at it. Or just a general new setup if that comes in. It's Affirm. Yeah, Upstart looks similar. I still feel like that Affirm has. I know we've talked about this in the past. If you've asked me about this one, I still think that Affirm's got more reward potential than Upstart does, but they look pretty similar to one another. And Twilio, I don't look at as much. Twilio looks a little bit tougher to me. It's well off these lows and this 56 support from that report. It had a pretty strong day today. Now I've got Apex Joy asking me about Ulta. This Ulta is a little bit of a tricky one, I think. Tricky chart to analyze because it's been so strong generally for so long, but then it had an earnings report where they gapped it down huge, but then they bought it up, and that was Thursday. And then today it had that was on Friday. And then today it had an inside day. So I would say that the chart actually looks fairly neutral to me here, and whichever way the inside day breaks, it'll look better or worse. If the inside day is able to break up and you're getting into the gap, then this thing's looking more bullish and maybe it's working towards the gap fill. If the inside day breaks down, then they don't like the earnings report and the chart's looking a bit more bearish there. So I'd say for the moment it looks more neutral. Let's see how the setup plays out. All right, everybody, looks like I got through all the questions in the VTF and YouTube. I appreciate everyone's participation. It's the questions that you guys ask that make these meetings really good, so always keep them coming. Don't be bashful if you're a newer trader out there, because this is how you're going to improve. I know some of you guys are bashful. Don't be bashful. Have a great night, everybody. See you all tomorrow.